Hey, welcome. Sorry for being 2 to 3 minutes late. Welcome to Capital Advantage Tutoring's live Series 7 SIE exam and all that other crap live Q&A. Any questions you guys have about any FINRA exam, I'm happy to help. If you like what I'm doing, please share this. I'm over 4,000 people, which is awesome. I only have to catch Notman left, and then that is it as far as Series 7 people, and then I'll be numero uno, even though number one in my head. I'm good anyway. Feel free to go down and hit my links. Go down and do the Amazon. You can buy some stuff. There's achievable link to buy some really solid stuff. Hey, Ruben. And hey, Ginger, Amana, and Wendy. How are you? Also, if you do the STC, you get a 15% discount on anything. Go from there. Anything. Also, if you want to learn how to trade, hit up Wall Street Global Trading Academy. I have a link. There's no discount or anything. But if you go in there, you get the guy who does the Wall Street Wrap-Up, Peter Tuchman and David Green. They will help you. They will absolutely help you learn to trade and how to technical trade if you're doing that. Okay. So, Ruben, I am happy about a 78 also. Jessica, how are you? I am very happy that you're moving up, that your scores just in time. You're peaking at the right time, which is awesome. Okay. Jessica, how are you? We're getting ready to nail this thing. Okay. Okay. How are you? Sister kissing analogy. I'm saying because it means nothing. Okay. Yeah, I'm working on it. Sasha, I have one. I'm doing a Series 6 one on Thursday, which is the same sort of thing. I'm probably going to do. Oh, got it. Psst, I got it. Okay. How'd we do? How's everything going? So I had that. I'm going to do one a week. I did the communication stuff. I only did a part one. Hey, Nilu, how are you? I'm going to do a part two much later because I got through the bulk of the communication chapter, which will help for any exam, SIE 6 or 7. That chapter will help you. Don't forget, I did a stock split one on Monday. We'll go in there. I'm just trying to come up with shit that if you guys have questions. So again, Jessica, the kissing the sister analogy is break even, which is like it's boring. It doesn't mean anything. You get nothing out of it. Like maybe in Alabama or something. But here, it's nobody cares. You're kissing your sister is there. Okay. There we go. We got a question. Treasury receipts versus strips. I like it. Okay. So both of them, as far as investing, there's probably no difference. Okay. There probably really is no difference. Eddie, how are you? Between strips and receipts. Okay. So a treasury strip. Okay. Cesar, how are you? So a treasury strip and a treasury receipt are both zero coupons. Okay. Long-term zero coupons are good for like 20, 30 years. You buy them at a deep discount and then they grow to par. And that's what it is. Okay. So now, if I buy a treasury receipt, think of it this way. It's issued by a broker-dealer. Try to think that they were issued before the government did. So treasury receipts are this. If I'm a broker-dealer, I buy a government bond, a treasury bond. And what I'm going to do is I'm going to split off the coupon and the principal and sell it as like two different products. Okay. So the strip is basically that is long-term zero coupon. So a strip is done by the government. A receipt is done by the broker-dealer. I'm just saying the same thing over and over again. So a treasury receipt is issued by a broker-dealer and you're buying it at a discount and you get par and maturity. That's it. You don't need to know deeper. You don't need to know that they're ripping it apart and giving you all this crap. I don't care. The bottom line is it's a broker-dealer issuing a zero coupon that's backed by treasuries, okay? The strip is just a treasury bond, but there's no coupon. You buy it at 600 and it matures at 1,000. That difference is your interest. There you go. Okay. Okay. That helps. So here's the thing about them. Are they volatile so Jessica, are treasury strips or receipts, are they volatile or not volatile? What a great question. Are they volatile or not? And Ruben, yes, I am super duper happy they got a 78. Did you go through I hope you went through all the answers. Okay. A deleveraged balance sheet. Okay. Let me go over that. Boom. Finally, freaking questions. That's good. Okay. Okay, now, what did we ask on? 1 second. Okay, now. So, oh, where'd I go? I lost everyone. I hope I didn't shut it down. Good. Okay. So now, X date. So dates for cash dividends. Okay. So it's the cum date. So Eduardo. So this is the way it goes. Okay. So remember DERP, DE. Very good, Jessica. They're very volatile because long-term and low coupon. Remember that, guys. Interest rate risk, the most volatile bonds are long and low. Long-term bonds, and then you look for the lowest coupon at the lower price, and that's going to be the most volatile. So now, hey, a deleveraged balance sheet just means you're taking the debt off. Like there's probably no debt on it. If they asked that question on the test, it had to be a test question. It had to be, okay? Leverage means debt, and deleverage means less debt. So what I'm doing is I'm paying off all my bonds without issuing new bonds to do that. So normally when interest rates drop, what we'll do is we'll issue new bonds to pay off the old ones. We take that money and pay off the old ones. But deleveraging means you're doing it without borrowing any more money. So that's what a deleveraged balance sheet is. You're reducing the debt without taking on more debt to pay for it. Okay. So let's talk about a cash dividend. So there's four dates I have to remember. DERP, and I think I have a video on this, even a TikTok, I think. DERP, Declaration X Record Payable. Remember that. For DERP, Declaration X Record Payable. So the declaration date is the day that we announce the dividend. Hey, we're paying a dividend. The record date is a day you must be an owner of record. What the hell does that mean? That means your bond has to settle. I even took freaking Zyrtec. Your bond has to settle on the record date, okay? So your bond has to settle on the record, or stock has to settle on the record date. So if the record date's Thursday, you have to buy it. If you buy it on Monday, you're good. It settles on Wednesday. If you buy it on Tuesday, you're good. It settles on Thursday. If you buy it on Wednesday, the stock settles on Friday, you're too late to get the dividend. So that's the X date. The X date is the first day of trades without you getting the dividend. That's always the day before, the business day before the record date, okay? Now, the day before that is called the cum date, Latin, C-U-M. It's cum. Very carefully, make sure you say it that way. It's cum date. The cum date is anything before. So everything trades either cum or X. Cum means with, X means without. So anything before the X date is technically a cum date. Anything after on the X date and later is considered the X date. X means without. So remember, ex-girlfriend means you Armana, that's awesome. X means without. X means you're not getting a dividend. Think ex-girlfriend, ex-boyfriend, no boyfriend, no girlfriend. Ex-dividend means no dividend. So ex-dividend is always a day before the record date. If you buy it on the record date, you're not getting the dividend. Now, are there ways to buy it after on the X date or later and get the dividend? Of course there are. If you buy the stock on a cash settlement basis, what does that mean? Cash settlement means that you're settling the same day. So think about it. What did I say? So you have to buy the stock so it settles on the record day, okay? So if you buy it on the record day, it's going to settle 2 days later. It doesn't work unless you buy it in a cash settlement, which means it's settling the same day. So you buy a cash settlement, it settles the same day. You can buy it on the record date and still get the dividend. Now the P part of the DERP is payable. That's when they mail the check. Okay, so the DERP is when they mail. So the payable date, the P is when they mail it. Nobody actually cares about that price that day. So remember, DERP, Declaration X, Record Payable. The X day is set by FINRA. Declaration, and by the way, congratulations, Romana, for nailing the health and life. That's awesome. So declaration is the day they announce it. Record is the day you have to be an owner of record. P is the payable. And E is the X date, which is the day before the record date. It's the first day you don't get the dividend. Now, to compound on that, if you buy it before the X date, the buyer gets a dividend, the seller does not. If you buy it on the X date or later, the seller gets a dividend, the buyer does not. Okay. Awesome. Now, qualified legal opinion versus non-qualified. So a legal opinion is for revenue bond. So if we have a revenue bond, it's either a GO bond or a revenue bond. So a GO bond means GO bond means that it's issued by the town or the city, and it's for stuff that's free to use. So the only way for them to pay their bonds is through taxes. Now, revenue bonds are for like subways and stuff like that, subways and anything that costs money. Now, like in New York City, the subway creates revenue, but it's not supposed to be profitable. It's just supposed to offset the costs a little bit. So the money coming in is covering some of the debt, and then the state of the town covers the rest. Most revenue bond, a lot of revenue bonds are like that. Some are strictly to make money, like if they rent out like an area and then they rent it to a corporation. Now, before you issue, thank you. If you issue a revenue bond, before you do it, you have to do two things. One, a feasibility study. Will it make money? You have to do a feasibility study. You have to look at it and see if it will make enough money to cover the debt service, or at least the portion that the state doesn't care about. The second part of this is you need a legal opinion. That's bond counsel, which is a fancy word for a lawyer. So bond counsel does a legal opinion. And if they either come back with a qualified or not qualified. The only two things they're looking at for a legal opinion are, is it tax-free and are they allowed to issue it? Because remember, so that the Port Authority and all these authorities that issue revenue bonds are private corporations that are authorized by the city or town to issue bonds for these revenues. So the bond counsel will look at all the statutes and everything and say, okay, they are allowed to issue it. And then they will look to see if it's tax-free, which means there's not a lot of corporate involvement. If there's too many private corporations involved in the revenue bond, then it might be taxable, so they would give you a non-qualified opinion. An unqualified opinion is a bad thing. That means we have some sort of issue with it. Okay, no, qualified, oh my God, see what happens when it's late? Qualified opinion, because I'm saying it, go, wow, that sounds wrong. A qualified opinion means there's something wrong with it, okay? You're qualifying your answer. You're saying, hey, yeah, you can issue it, but it might be taxable, might be subject to AMT. If it's qualified, you might not, the lien on the property might be bad, okay? So all of that, so a qualified opinion means there's some sort of issues, you're qualifying it. Non-qualified opinion means that it's totally cool. It's totally, you're 100% you're allowed to issue it, and there's no issues. So non-qualified legal opinion is good. A qualified legal opinion is bad. Okay, there we go. Okay. Net basis. Okay. So the next thing we have for Jessica is we have net basis, and to understand net basis, we have to understand what principal trading is. So if you're a market maker, you're going to trade using your own principal and you have risk because you buy the bonds, you buy the stocks, whatever it is, you're owning the stocks. Okay. So if you own the stocks, the thing is you have risk. Okay. The risk, it can go up or down or whatever it is, and you may lose money in your position. So there's another part called a riskless principal. Riskless principal is I'm a market maker or whatever, and I don't take a position first. So what happens is you give me an order to buy 1,000 shares of IBM at 50. With your order in hand, I go and buy the 1,000 shares of IBM at hopefully at like $49 or $49.50. Let's say 49 to make it easy. So I buy it at 49, and then I turn around and sell it to at 50, and I make $1, but I have to disclose it. The reason it's called riskless is because I'm not taking a position until I have an order from you. So you give me an order to buy 1,000 shares at 50, I go buy it at 49, and then I turn around and sell it to at 50 with $1 markup. So that it's also like a commission. So I have to disclose that too. You have to know what I'm charging you. You're going to see that I bought it at 49 and sold it to you at 50, what's charging you a $1 commission markup. Now, net basis is very similar, but we don't disclose the markup. Now, again, riskless principal is I buy the stock at 49, I turn around and sell it to you at 50. Only the 49 will be the 49 will be reported on the tape. The 50 will not. So only one trade gets reported to the tape, and we disclose their markup. If it's a net basis, basically same situation. I buy it at 49. I turn around and sell it to you at 50. It's considered two separate transactions. I buy it at 49. I sell it at 50. I don't disclose the dollar markup. It's not your problem. And it's going to both trades, the buy at 49 and then the sell at 50 are both going to show up in the tape when with that going. Now, the thing about net basis is I don't have to disclose the markup. So the thing is that's ripe for a ripoff, right? So what they do is if you're a retail customer, I have to get permission every time I do a net basis trade with you, every single time. Okay, I have to get permission every single time that I do a net basis trade, I have to get permission because I'm not going to show you the markup. Or if it's an institution, I can get what they call a negative consent letter from an institution one time. When they open the account, I can send them a letter and say, hey, you know I do net basis trades. Are you okay with this? So the negative consent letter basically says, if you have a problem with it, you have to reach out. If you're okay with it, then you don't have to do anything. So negative consent means no news is good news. If you don't come back to me, then I'm considering it's okay. That's only allowed for institutional accounts. Retail, you have to get permission to do a net basis trade every time. Hope that helps, Jessica. Now, can the 5% markup be applied to agents as well? Yes. So 5% markup is about, okay, so 5% markup is for non-exempt securities, basically stocks and bonds that are non-exempt. They're not supposed to charge, it's a guideline. They're not supposed to charge more than 5% markup, markdown commission, okay? If they do, then you can get in trouble, but it's a guideline. If you're going to charge more than 5%, you better have a damn good reason. Like it's an illiquid stock. It took me a week to buy it, whatever it is. You have to have a good reason. Okay. And remember, it does not apply to exempt securities. And remember, the 5% guideline is not about you. It's about the security you're selling. Okay. Can I explain assumed interest rates? Okay. So assumed interest rate. So variable annuities. So what happens? So variable annuity, I'm going to jump to the end because I'm going to assume that you've watched my How to Pass a Series 6 video. So variable annuities on the payout phase. You're getting paid every month. If it's a fixed annuity, once that number's set, we're done. It doesn't change. But done. So depressing. So variable rate, when you get paid out, you're going to get a certain amount of money each month. The amount of money you're getting is based on the value of your separate account. So you have a separate account or a sub account. Okay. Okay. Now, let me cover this because if I read it, I get screwed up. Okay. So now, my ADD. Guys, if I'm answering your question, do me a favor, hit like, and when you get a chance, go down in the links and patronize those people. Help me out here. So now, okay. So we have a variable annuity. The rate of return is, thank you guys. So the rate of return is going to move up and down based on your investments in the separate account or the sub account. So if they go up or down. AIR is a benchmark. So AIR is your benchmark. Say it's 5%. So if you have an AIR of 5%, if the variable annuity sets an AIR, assumed interest rate of 5%, that's your benchmark. If you do better than AIR, your payment the next month will rise. If you do worse than AIR, your payment the next month will drop. If you do the same as AIR, your payment will stay the same as last month. So when they compare your rate of return, they compare it to the original AIR that's set. Then whether it goes up or down is based on whether you beat it or miss it. But it's going to be based, so the reset number is your last month's payment. So if we made $500 this month and AIR was 5% and we earned 6%, our payment will go up to like say $550. I'm making up numbers. If the next month we do 5% matching AIR, the payment will stay at $550 because that's your new reset number. That's your new lock-in, okay? So assumed interest rate is just a benchmark. It's not a guarantee of anything. If our return beats AIR, then our payment goes up the next month. If our return loses to AIR, then our payment goes down the next month. If we match AIR, then it stays the same. Rose, how are you? Okay. Hope that helps, Georgiana. Okay. Now, so this is for the 63, 65, 66 crowd. So qualification is for interstate. If we're going to register in one state only, it's qualification. For those taking the SIE in the 7, that is going to be what they call an intrastate, which is a Rule 147 exemption. You don't register with SEC, you register with the state only, but everything has to be in the state. You can't have any investors from outside the state. Now, if you go beyond, no problem, Georgiana. If you issue your shares, this is about securities registration. If you issue your shares outside one state, then the SEC has jurisdiction and you have to do coordination. Coordination is you're registering both. Awesome, Rose. That's awesome. So if coordination is you're registering with the SEC and the states, you're not coordinating between the states, you're coordinating between the SEC and the states. So if the SEC, so you're going to register with the SEC, that's a 20-day review and all that stuff, but you're also going to register in the state. So all of you who've taken the 7 or the SIE, you might remember the 20-day review. That's what we're talking about. You register with the SEC. During that time, you blue sky the issue, which is registered in the various states. And there we go. Now, coordination is for securities that are not on an exchange or not exempt. So these are for securities that are non-exempt, but not on an exchange also, which would be exempt. Notice filing is for like mutual funds and Reg D 506C. So Reg D 506C and mutual funds do not have to register on the state level, but the state will require them to notice file and just let them know that they're being sold in the state. That's all it is, okay? Now, the last one is if it's an exempt security, if it's on the exchange, it doesn't register in the states at all. It's totally exempt. Okay, there we go. Flow of funds, gross and net. It's okay. So the ones you will have to know for, so muni bonds, not munis, GOs, but new muni revenues. Revenue bonds bring in money. Okay. So revenue bonds bring in money every month, every day, whatever it is. So the question is, where does the money go? So it's either gross or net revenue. So if it's gross revenue, so they pay there's two choices and everything else is the same, and you can look that up. But the first two choices are debt service or ops and maintenance. It's either, no one, John, no problem. I just saw you pop in. So the flow of funds is where the money comes. The first place it goes is to the revenue fund, which is like their bank account. Then the question is, do you use it to pay off the debt called debt service, or do you use it to pay off the salaries and ops first? And that's gross versus revenue. Gross means that you're paying off the debt service first, and then the ops and maintenance of the revenue bond of the corporations, the authority. If it's a net revenue pledge, then you're paying the ops and maintenance first, and then you're paying the debt service. So again, gross means you're paying the debt service, the bond service, out of the gross revenues before they take any. Sandy, how are you? Okay. So again, no problem, Justin. So then we jump on this. So if it's a gross revenue, they're paying the debt service first, and then the ops and maintenance. If it's a net revenue pledge, they're paying the ops and maintenance first, then the gross, and then the debt service. Because it's all about where you're getting the debt service out of. So if it's gross, it's out of the first money coming in with no deductions. If it's net, you take the deductions out and then pay the debt service. Okay. What's the difference between an insider and an access person? Okay, so an insider is more about issuers. An issuer is like, or I guess it could be a principal person. An access person is just someone who either handles money or has control or deals with customers. They're not going to make it define an access person. They're going to want to know what they do. So for an investment advisor, an access person, and for the investor. So look, so guys, remember, so if you have SIE questions, Series 7, Series 63, 65, 66, Series 6, all these exams, I'm helping you out. So now, if you are an insider, you are at 10% more, or you're not a control person, but you're more than 10%, or you're in possession of inside information. Now, and that's for issuers. An access person is someone who is either dealing with customers or touches the money for an investment advisor. What do they have to do? Every quarter, they have to disclose, at the end of the quarter, they have to disclose all their trades. That's one thing. At the end of every year, they have to give a holdings report listing all their holdings, okay? So an access person has to list all, okay. They have to list all their, all their holdings periods. So Vance, who comes on here sometimes, passed the SIE. How happy is that? I love that. That's awesome. If you're on here, congratulations. Okay. Let's make sure nothing else came through, because some people like to trade. Okay. Boom. Some people like to send text while I'm there. Okay, good. Okay. Hope that helps. That is kind of it. Well, we're going to be a 30-minute session today. No, I'm kidding. I don't care. I have a student at 9:30, so that's my cutoff. They don't? That's interesting. Okay. So yield to call. Okay. That's funny. Yeah, you can do that. Okay. So yield to call. Okay. So yield to call is if it's a discount bond, it's going to be the highest yield, and yield to call on a premium will be the lowest. Now the question is why? So if you buy a bond at $800 and say it's a 10% bond, you're getting your $10. Your current yield is 12.5%. 100 divided by 800 So that's 12.5%. That's the yeah, perfect, Ruben. You got it. So, okay. I can't believe they don't talk about it. That's very weird because it's definitely going to be on there. As I said, training consultants very much so gives you bare bones. I don't love them as a primary, but I do like them as a supplement. So, yield to call. So if you buy a bond at $800 and it's 10% a year, so your current yield is going to be 12.5%. But what do you get at maturity? Okay. What do you get at maturity? Okay. So maturity, you're going to get 1,000. So that means you're also getting, an extra 2,000. Okay. That means you're getting an extra 2,000. What am I talking about? I'm an idiot. Okay. Let me think of it this way. So if you buy a bond for $200 for $800, well, okay, scratch that, reverse it. Please, everyone, forgive me. There we go. So buy a bond for $800, it's 10 years to maturity. A 10% bond for $800, it's $100 over $800 is a 12.5% current yield. If I hold it to maturity, I'm getting an extra $200. That's a little bonus. So that's going to increase my returns because, hell, I paid $800. I'm getting $100 a year plus an extra $200 when it matures. So my yield to maturity is going to be higher than current yield because not only am I getting the $100 a year, I'm making $200 in like 15 years. Yield to call is if it happens sooner. So yield to call is a yield that if you held it to the first call date. So if they call the bond, if I have a discount bond and they call the bond, okay, if they call the bond, that means I'm getting an extra $200 even sooner than maturity. So my rate's even higher. So remember, so on a discount bond, it goes coupon or nominal, current, yield to maturity, yield to call. It's always that order. Coupon, current, yield to maturity, yield to call. Remember that. Coupon, current, yield to maturity, yield to call. On a premium, and they always quote yield to maturity because it's worse, okay? Okay. Now, on the premium side, premium side is going to be coupons the highest, then current yield, then yield to maturity, then yield to call. If we're going to quote bonds, if it's a discount bond, we do yield to maturity. If it's a premium, we do yield to call. And the why is yield to call lower? So let's say, say we buy a 10% bond for $1,200, that's like 8.3%. So that's your current yield because you did 100 over 1,200. That's around 8.3. So that's your current yield. Now remember, if you hold the bond to maturity, you're only getting 1,000. So you paid 1,200 for it. So the problem is you're losing $200. So that yield to maturity is going to take into account the fact that you lost that $200. So it adjusts. But it's going to be in 15 or 20 years. So it's not going to be that painful. But if it's called, it may be called in like 5 years, which means you're losing the $200 like that. So yield to call is going to be lower because you're making less money. You're losing your money even quicker than if you held it to maturity. And remember, so discount is coupon, current, yield to maturity, yield to call. And then on a premium, it's the same order, but from at a low. Coupon, current, yield to maturity, yield to call. And remember, you always quote what they call yield to worst. If you quote a discount, it's yield to maturity. If you quote a premium, it's yield to call. Okay. Okay, so Georgiana, muni bonds purchased at a premium versus at a discount. Okay, so I've done a thing on this, so watch it, but I'm going to tell you right now. So if you have a bond at a premium or a discount, if it's an OID, which is a zero coupon, you must accrete, okay? If it's a coupon, so what happens is if it's a zero coupon OID, you must accrete. So if you buy the bond at 800 and it's 10 years to maturity, the discount is $200. They're going to make you accrete that. The IRS makes you accrete that. They make you divide the 200 by the years to maturity. 200 divided by 10, that's $20 a year. So you're going to increase your cost basis, not proceeds, by $20 each year, and then that's your new cost basis. So in our case, it's $20 a year. If after 2 years you sell the bond for $850, well, our new cost basis is $840. Why? I bought it at 800. It's 10 years to maturity. 200 divided by 10, that's $20 a year. After 2 years, my new cost basis is $840. I sell it at $850. That's a $10 capital gain, plus I paid income on this side. So remember, the only time I have to accrete is if it's an OID. Now let's jump over to the premium side. The only time I have to amortize is if it's a muni. Corporates and treasuries do not have to amortize. What the hell is amortizing? Again, watch my video on this, but I'm doing the quick and dirty here. So if you buy a bond for $1,200 and it's 10 years to maturity, that means it's $200 over par, because whether it's 5 years or 10 years, it's still $200 over par. 200 divided by 10 is $20 a year. That means you're going to drop the cost basis by $20 every year. You don't get a tax break for that. You just your cost basis is lower. Georgiana, I hope that helps. I do have a video on it somewhere. I think I just did one. So go take a look at that. Okay. But I hope that helps. Remember, here's the key. If it's an OID zero coupon, you must accrete. If it's a premium, only the munis have to. Corporates and treasuries don't have to, and they wouldn't. So why would you? Okay. Hope that helps, Georgiana. What is strategy-based margin? So normal margin is Reg T. You have to put down 50%. Strategy-based means we're actually going to look at your portfolio. It should be called portfolio margin, but it's not. Strategy-based margin takes a look at your entire portfolio and says, okay, well, based on the non-volatility or volatility of the portfolio, we're going to charge this much margin. So the whole point of it is so that you have to put down less money and you can borrow more. So strategy-based margin is based in going, look, I have Tesla and I have Ford, or I have Tesla and I have, so I have Microsoft and I have Apple. They kind of offset each other. So then you're going to lower your premium, lower your margin requirement because there's less risk. So it's basically how the riskier your portfolio is, the more margin you have to put down, and the less risky it is, the less you have to put down. It's not available for schmoes like us. You have to be rich. And I think it's either 5 million or 500 grand. I don't care really, but you have to have a lot of money in your account. And they can do that, and that gives you more leverage. But it'll never, remember, even if it's a super risky security, you'll never have to put down to more than 50%. Okay. Hope that helps. Standard deviation in Monte Carlo. Okay, so this is what you know. Okay, perfect. So this is what you need to do. Does that mean I didn't do a good job explaining it, Georgiana? I hope not. Okay. So standard deviation is volatility. They're not gonna make you figure it out. I know the books do, but standard deviation is the volatility of a security. The higher the standard deviation, the more risky the security. That's what it is. And how do they get it? One of the ways they do it is this Monte Carlo simulation. So the Monte Carlo simulation is like, we go to Monte Carlo, we bet cars, play baccarat or blackjack. No, it's just a stupid joke because it's late at night. So Monte Carlo is every time you work at a big firm and you have a portfolio, they run multiple scenarios, like the interest rates go up, the discount goes down, we're at expansion, contraction, all these different economic scenarios at your portfolio to determine what would be likely to happen if this happened or that happened or whatever it is. So those, like if a pandemic hit or it didn't hit, or if we had a cure, didn't have a cure. So all these, the Monte Carlo is just running a bunch of situations at a portfolio to determine how wide the variances are, how good versus bad. And that's the standard deviation. The bigger that is, the bigger the standard deviation. The tighter that is. So you may have a stock like a boring Gillette. Economy is good, bad. It's like going to go up 5% versus up 3%. I mean, it's boring. So the standard deviation is very tiny. But if you have like a biotech, it's like, oh, this happened, then this happened, or Tesla. Tesla's very, very reactive to the market. So if you have really good things, Tesla will go up. If you have really bad things, Tesla will go down a lot. So that's what Monte Carlo is throwing, all these different scenarios at the portfolio to determine the upper level, and the lower level of its earnings. I got through all that. I can't believe it. Okay. Everyone's either falling asleep on me or they're so wrapped in such rapt attention that it's just mind-boggling. Okay. Okay. The new issue rule. So 144 and new issue have nothing to do with each other. So the new issue rule is basically talking about if you work for a broker-dealer or in the business, or you're a money manager or an investment advisor or whatever it is, or you're a fiduciary, which means you're a lawyer and you do a lot of your business for the broker-dealers, then you cannot buy an IPOs. That's what it is. So you cannot buy an IPOs for yourself. You can buy, if you're managing a portfolio, you can buy it for your portfolio because you're people, but not you. The exception to that. So again, nobody who works in the business can buy common stock IPOs. I mean, IPO is always a common stock, but I just like to say that. You can buy additional offerings. You can buy it once it starts trading, but not on the IPO, because the theory is that we're trying to save it for the retail investor, which is a joke. Now, there are exceptions to this. One, if your spouse works for the issuer, like say I was going public and, let's say I was going to bring my cat's tutoring public and, I wanted to buy some shares. I can because I work for the issuer. Or my wife did. Or say my wife worked for Boeing and they wanted to issue new shares like an IPO. She could get shares because she works for them. That supersedes our rule because they think it's such a rare thing. Another one is if it's like an investment club or a fund, as long as a registered rep or the restricted person is not perfect, Rose. I love that. Get reading on it. Get on the 63. Let's do this. Read the book first. That's all you have to do. So if you have a fund or a investment club or something like that, and the agent or someone who works with a restricted person is more than 10% ownership, then they can't buy on the IPO. But if it's 10% or less, then we can. So if I have an investment club with 10 people in it and one of them's a registered rep, I'm good to go. If two of them are registered rep, then it's not so good, okay? Because it's over 10%, then the investment club can't buy on the IPO unless, of course there's an exception, unless they do a carve-out. A carve-out is where the investment club buys it, but the actual person who works for the broker-dealer doesn't benefit from it at all. He doesn't get any of the upside or downside. So you're carving them out. Same thing with hedge funds or groups. Anytime a group that wants to buy shares, if there's a registered rep in the group, they have to either carve them out or hope that they're less than 10% of the group. Okay. 144 is 100% different. 144 is under two different things, and I definitely have a video on this. So 144 is either you're for control people, if the people are more than 10% owners, or partners, officers, directors, they have their own rules. And then we have 144 for restricted shares. So let's do the 144 for restricted shares. Okay. Restricted shares are shares like Reg D, where you have to hold them for 6 months fully paid. So if you buy shares of a private placement Reg D, you have to hold it fully paid for 6 months. That's what 144 says. That's one of them. The other one is for control people. Control people are the pods, partners, officers, directors, 10% owners. They are, or anyone else deemed to be a control person. So partners, officers, directors, that's the C-suite staff, all that. Those are control people. They do not have a holding period, but they cannot sell shares any faster than the 144 rules allow. So if they want to sell shares, they have to fill out a form 144, and it's good for 90 days. They can sell the greater of 1% of the outstanding or the 4 weeks trading volume, and they can do that every 90 days. It's built into the rule, 144. 1% of the outstanding, 4 weeks trading volume, 4 times a year. Okay. Okay. Hope that helps. We can briefly touch on the time value of money, but by the time we're done, the money would be worthless. Okay. Yes, 144 is selling. Now, Jessica, 143 is an exemption to that. 143 really is about buying. It allows quibs to buy. It is allowed. I try to be that way. It is allowed to buy shares during the restricted period. So if there's a restriction on selling, you can buy during that 6 months. That's what. Oh, good, Armand, I love it. Peter's great. So if you want to sell your 144 stock during the 6 month holding period, you can't, unless you sell it to a quib. And a quib is never an individual. It is always a firm. It is an institution that, like a financial institution, that manages at least $100 million or more. Okay. Now let's talk about the time value of money. Jokes aside. So money now is always worth more than money later. Always. Okay. Money now is always, okay, I can work on that, Ruben. Money now is always worth more than money later. So if I have a choice of getting money now, $100 now or 120 later, I take the $100 now because you can invest and earn more. But think about this. So when you guys, let's go with it. When I was a kid, a young kid, I saw Grease, all that. I used to go to the movie theater, and my mom would give me $20 to go to the movies. I could go to the movies because movies were $1.75 or $2 at the time. I could go to the movies and bring 3 or 4 friends with me and get popcorn and get soda for $20. Fast forward to now, if you go into New York City, your $20 might not get you in. Okay, so the value of $1 drops as prices go up. So inflation eats away at the value of $1. That's why we're talking about right now. We have high inflation costs. Costs of goods are going up really fast. So that's making your money buy worse and worse, less and less money. Over time, dollars always get cheaper. That's just normal. We want some inflation. We want like 2 or 3%. 2 is a better number. 3 is not great. But anywhere between like 1.5 and 2.5% is good. It's a healthy rate of return. But that also means every year that your dollar is worth less and less. So if you say you make $10 an hour as your job, so let's say $20 an hour as your job, and you get and you get a small raise, like say you get a 2% raise, so you're going to get an extra like 40 cents an hour. Okay, you think that's great, whatever, but all that's doing is keeping you up with the increased cost of living. So every year, everything you do costs 2% more. So if you get a 2% raise every year, they're just keeping pace with inflation. They're not beating it. Okay. So now, Ruben, so time value versus intrinsic. So time value, well, let's talk about intrinsic first. So intrinsic is also known as the in-the-money amount, how much the option is worth. So if we have a call, doesn't matter buy or sell. The buy or sell option doesn't matter. It's just the call. So a call is the right to buy. So remember that. Selling a call is selling a call. Ruben, you got it. So it plus other things. So selling a call is bearish, but has nothing to do with intrinsic. Intrinsic has nothing to do with you, whether you buy or sell or your premium. So if you have a 50 call and the stock is trading at 54, you have $4 of inflation of intrinsic. If the stock goes to 58, you have $8 of intrinsic. If it goes to 42, you have zero. There's no negatives on Wall Street. So it's the amount the option is in the money. Buy or sell and premium doesn't matter. It's not about profits. It's just a term in the money. So anything above the strike price on a call is called intrinsic. So let's go back. So let's say I buy a 50 call for $8. That's my premium of $8. If the intrinsic is 5, if the stock is trading at 5, the intrinsic is 5, which means the extra, the $3, is called time value. Time value is the amount of premium that's over what it's worth. So in reality, if the stock was trading at 48 and I bought a 50 call for $3, since the option is out of the money, the entire value of the option, the premium, is time value. Let's drop off again. So on the put side, everything below. So put strike of 50, anything below 50 is in the money. So if the stock trades at 45, it's 5. If the stock trades at 40, it's 10. If it trades at 30, it's 20. Do you notice I didn't mention premium, okay? Okay. If I have a put, buy or sell, the in-the-money amount is below the strike price, in the money / intrinsic. And a call, whether you buy or sell the call, intrinsic is the amount above, okay? And time value is the amount of premium that's more than intrinsic. So again, on the put side, stock's trading at 46. I buy a put for $6, $7. While the $4 of intrinsic, that means there's $3 of time value. Time value is what you're paying above what it's worth. Boom. Okay. Okay. So why is inflation going up so fast? Okay. So we're giving a lot of money to people. And, unemployment checks are still being extended. Oh, that's not as big a deal. A lot of states are getting rid of that. But we're pumping, and this is not just a Biden thing. We've been pumping money into the economy pretty much since 2006. So we don't know what's going to happen, right? So the more you pump money in, and then you're giving a lot of money to people, and then just prices keep rising. That's why we have a lot of inflation, because it's a very weird time right now, and we're pumping a lot of money into the economy through like tax breaks and rebates and just straight up checks to people. So that's good. So when people have money, so I knew that if I know that that all the people I know were getting a $2,000 check every month from the government, that means I'd raise my rates. I'd be like, wait, you can afford it. I'll raise my rates to $175 or $200 an hour. That's just normal. So if people have money, we raise rates. That's inflation. So the whole point is supply and demand. If there's a lot of demand, the prices go up and there's more inflation. If there's a lot of supply, the prices go down, and then there's deflation. Hope that helps. Jessica, I can do one more question if you have one, but don't really try to kill me. Okay. And if not, I am heading out of here. Okay. Right. Okay. Ethan, I can. Ethan, before I do that, what time when are you taking the test? Wow. Did you see them on the exam, or are you just reading the book and seeing that? Jessica, I'm asking you about floating rate. Oh, you taking it Thursday? Okay. So here's what you have to do. So I'm not going to spend a whole 20 minutes doing Ethan. I'm not going to spend a 10-minute thing because I have a video on it. I have a video called How to Pass the Series 6. I know you're probably taking the 7. Wait, Ethan, are you taking the SIE or the 7? Okay. On the real exam or on one of the test ones? So a floating rate tranche is for CMOs. Okay. Oh, okay. So that's fine. So if you go watch, I'll give you enough. So if you go watch my How to Pass the Series 7, and it's called How to Pass the Series 6 and 7, go into my oh, I gotta show it. Oh, okay. So I'll explain it, but I doubt they're gonna ask that. That's really super deep on your test. So if 2-pack and oh, that's funny. Okay. So now a variable annuity is an insurance product. And you're putting money in during accumulation phase. It goes non-qualified. It grows tax deferred. You're putting it in. If it's a fixed annuity, it grows at a fixed rate. And again, Ethan, I'm doing it super fast, but find the How to Pass the Series 6 and 7 video. It's either it should be in my series. Just type it in. It's called even look into the Series 6 playlist. I know you're not taking that, but it's an entire 45 minutes on mutual funds and annuities, and it'll explain everything. People will listen to it. I know you're taking the SIE, but it'll help you, and it'll help you for the next exam. But I'm going to do the quick and dirty here. So money goes in after tax, non-qualified. It grows tax deferred. You don't pay taxes on it. That's called the accumulation phase or the pay-in phase. Anything perfect. So if it grows in value, you're not paying taxes on it because it grows tax deferred. Now, once it gets to annuity phase, when you're 59 or whenever you want to do it, you can choose to annuitize, where they're going to pay you out till you die. Okay. So I'm giving you basics. There's more details in that video. So what happens is, say you have $100 grand in your account and you want to get paid over, you're going to live for 20 years. That's their guess. They're going to pay you 100 times divided by 20, the years that you have until you're going to die. So that's going to be $5 a year. So again, they take 100 grand, they divide it by 20 years. That's going to give you $5 grand a year. That means you're going to get like $400 a month. So you're going to get $400 a month until you die. So if you live for 40, 50, 60 years, you're going to get paid for all that time, even if they thought you were going to die after 20 years. If you die before before all your money gets out, nobody gets the money. The insurance company keeps the money. Ruben, I'll see you tomorrow. So an annuity, and a variable annuity, the payoff phase is the goal is to be paid for life. Okay. And you'll get paid until you die. If you die early, then you're dead, so you don't really care. But the rest of the money goes to the insurance company, depending on what choice you choose, which covers in the video. Here's the thing, though. So if you outlive it, you're going to get more than you spent. If you live shorter than you're expected, then you're going to get less. But you're dead, so you don't care that much. Okay. Awesome, Chloe. I'm so happy. Congratulations. Of course I do. I'm working on it. These videos are for SIE 7, everything. I do tutoring on that too, but the whole point is I'm starting going through the Series 7 book, but I probably won't be done for a few weeks. I mean, it's 20 chapters and it's a lot of chapters. Okay. Now, yeah, of course I can. Reach out to me. We'll work on it. But go through my videos first before you do anything. I have a whole Series 63 playlist. Go through them. And then if you want to meet up, hit my website, series7exam.org, and you can do it. I'll even put it in here just because I'm a shill. Boom. Hope it comes through as a link. So now I took that one because I realized org doesn't matter. So back to this. So watch that thing. So variable annuities, keep in mind, all variable annuities are non-qualified, which means the money goes in after tax. And then when you take it out, you only pay tax on the growth portion, not the what you put in. Variable annuities are better for younger clientele, 60 and under, anyone over 60, 65, 70. Fixed annuity is better because a fixed annuity, you get a set payment every month. On a variable annuity, your payment changes every month based on how your separate account does versus there, which I did way in the beginning, I think, for Georgiana. Okay. I think that's it. Okay. So floating rate tranche is really just these tranches where the rates are going to change. Okay. That's all they're talking about. They're just saying that it's a variable rate. Whenever you see floating rate, it just means it has a variable rate that changes with the economy. And the big thing about that is that means you really shouldn't have any interest rate risk. Okay. So what happens is so keep in mind that what they're doing is, again, the rate floats, but it's on a preset thing. So it's not like they just adjust. They preset it. So on whatever, maybe it's every month, every 6 months, every year, they adjust the rate compared to what's going on right now. That's what a floating rate tranche is. Floating rate tranche is you're adjusting the rate. Okay. Perfect. We'll get there. So Go to the website and you book it. It's right on there. But go through some stuff first before you do it. I'd love to take your money, but we don't need to do. Okay. Now, and then John, it's going to be the last one because I do have a student and I want to eat something because I can't eat for 16 hours after because of the stupid fast. So, intermittent fasting is such a pain. It works, but it's such a pain. Now, yeah, reach out to my website, watch my videos first. So now, discounted cash flow. Discounted cash flow this is for the 66 for the most part and 65. On the really quick version of it, discounted cash flow is the method of discounting your future value. So what you're doing is you're taking all your future cash flows, all your bonds, your interest rates, your dividends, whatever is coming in, and you're discounting it for a discount rate. Okay, so you're discounting it back based on inflation. You're trying to find out what your future value is and bring it back to now to say, okay, 20 grand in 5 years plus the interest payments are worth what in today's dollars. So the whole point is go on my website and it should be a book now button and just hit it. It doesn't matter what it is. I know what you just type in Series 63 in the notepad. If you go to my website, you hit book now, it'll show up the choices with Zoom. Don't do in person because that doesn't work anymore. I mean, you can, but whatever. It's more money. So, okay. So discounted cash flow is taking, and you will never have to do the math on this. They won't make you do it. You're taking all the future money and bringing them back to get present value. So remember, discounted cash flow is a method. It's not a final number. It's a method to discount all your cash flow. Okay. So Michael, hope that helps. Let's go to the website, hit book now. Guys, if you like what I'm doing, please feel free to hit a session up. We can spend an hour together, just have some fun. It's not free, but it's fun. If you like some of the books, if you like Achievable, hit the link, buy the stuff. STC, you can hit the link also and get a 15% discount. Oh, the membership thing, which I never talk about. I should have. Remember, if you do the membership thing, if you do the lowest level, you get access to my option videos, which is $10 a month. If you jump up to the $24.99 one, boom. Okay, if you get to $24.99 one, you get a once-a-week Zoom meeting. Now, there's no limit to how many people can be in it. Right now, it's maybe max 2, 3, 4 people, but I'm not limiting how many people can be in it, but it is a Zoom lesson. That's $24.99 a month. The $99 a month is every other Tuesday. I did one today with Ryan. I do a Zoom session with max of 2 people, and I try to match them up tester for tester. Okay, test for test. So if I have 4 people, I'll try to match up SIE and 7 or 7 and 7, and then the 60 exams as on a separate day. But I think it's worth it. I think it's a good deal. Anyway, feel free to do that. If you want anything from Amazon, click the link. Boy, I sound like an affiliate marketer. Guys, everyone, wash your hands, keep safe, and go past this shit. We got this. We got this. We got this. See you Thursday. Oh, by the way, real quick, August 2nd at Uncle Paul's on 45th Street is going to be the pizza party. If they won't let me in there, I'll bring it to my office. We'll just do it there. And we're going to do like 6 o'clock on that Tuesday, August 2nd at Uncle Paul's pizza place, right by JP Morgan, right by Grand Central, very easy to get to. And we're going to rock this thing. We're going to have a good time. If anyone shows up, I watch. It'll be just me, and I'll be boring. And then we'll do the live. I'll do the live at 8:30. Everyone can say hi, get on YouTube, and then we go from there. Y'all have a good night.